Well, hello everyone. Thanks for joining me. Today we're going to cover a company that I spend like a lot of what I know is because of that company. I'm going to cover Cenovus Energy. I'm not currently affiliated with this company, but I did spend 9.5 years working for Cenovus some time ago. I would argue like most of my development and my expertise is basically from that amazing company. So I have a little bit of a bias, but one thing I would say is that I have many dear friends there, many mentors, and overall I think it's an interesting. It's a very important company. It's a very important company, and I think one of the things we're seeing on Twitter is some expectations. That this company is supposed to perform in a certain period of time, and maybe it's not doing as well in a week to week basis, but I think just the scale of the company and how important it is, I think, in the Canadian oil and gas sector, um, deserves to this type of live and just to talk about it. I currently don't have a position, so there's no conflict of interest. Yeah, and just excited to share. Everything I'm going to share here is in the public domain. All the slides, all the links will be shared and with the community here. The goal here really is to do something more educational for the community and just kind of cover some companies and do in the detailed examination of those companies. So if you guys want to support me, I have a book. It's called Apollo Autism. I sell it on Amazon. Here it is. So yeah, I'm just very proud of this book. This book was written to help families, support them to have a happier tomorrow. And yeah, I'm just very proud of this book. It's about an engineer that used to work for NASA. It's a fictional story, but a lot of the story is about my own journey. So just kind of very excited to share this with the community as well. Okay, so before we talk about Cenovus, I wanted to, and by the way, for those listening on Spaces, I'm doing a live now on Twitter and on YouTube as well. So I'm showing slides, I'm showing lots of videos. So it's a fairly interactive live. So before I get into the details about Cenovus, I want to show you a video that describes a little bit of so I'm going to be showing a YouTube video, and what it shows really is from Canadian Association of Petroleum Producers. Here's the link there, so you guys can look it up, and you just Google Cenovus Energy SAGD. Let's watch it quickly. So basically, the discussion here is about steam-assisted gravity drainage. And if I was to pause there, you can see where some of those regions are located in Alberta. You can see the main Athabasca area, kind of in that northeast corner, the Cold Lake area, and Peace River area, right? So this is Alberta and kind of overlaps with Saskatchewan a little bit. So that's where a lot of, that's where the bitumen basically is. So the heavy oil. And most of it actually is not mobile, so it cannot just flow. A lot of it is located basically near Fort McMurray when it comes to mining operations. But most of the resource, over 80% of the resource, is located on the ground, so you can't really mine for it. So I think it's really important to mention because Cenovus operates in those regions. It operates in the Cold Lake area, but also kind of at the south corner of Athabasca region in the Christina Lake asset. So I think it's important to cover that. So as shown here, you can use two methods. You can use drilling. So basically, that's the in situ recovery, where you basically extract the oil from underground, and you can use mining, where you mine for it. But majority of the oil is mentioned. It needs to be drilled for, right? So majority of the resource. So what you see in here basically is you go 800 feet underground. I think they use 800 feet, but reality is about 400 meters or so, 300 meters. 800 feet, I think it's like 250 50 meters maybe, but you can see the different layers that are located. So you'll have a lot of facilities kind of at the surface, and then essentially you utilize a process called steam-assisted dry reduced drainage, or for short SAGD. It was invented in 1978 by Roger Butler. There was a mechanism before through University of Alberta to basically reduce viscosity of oil by heating it. I think in 1920s, or if I'm not mistaken, Dr. Clark from University of Alberta developed a method on how to basically reduce the viscosity of oil using steam or using hot water. But in 1978, for the first time, there was this discovery that you can use a well pair, so injector and producer, and have a continuous process on how you would recover the resource. So as you can see here, basically Canadian Association of Petroleum Producers here in their video, they do a good job describing the main difficulty associated with bitumen, which is just too heavy to flow on its own, and it's just too viscous, right? It's also fully saturated in sand, and there is some water saturation as well. So how do you bring it to surface? What method would you use? And so that method is called SAGD, right? So basically, the next step, what you do, you drill. So they basically show you here that you will use steam to bring the product to surface. So what's going on here? You're seeing two wells being drilled. The method for drilling those wells called MWD, measuring while drilling. What ends up happening is that you drill a well, and the other well follows the trajectory of the first well. So basically, this way you create an environment where there's two wells that are kind of on the vertical scale. They're parallel to each other. So this way you can steam with the injector and produce with the producer. And so that's kind of what you see in here in that video. Now, the next step is you have this injection well, right? And on top of the sand, you have also cop rock. And then you have this production well. So steam is being injected, as you can see here in their video. And basically heat transfers to mobilize the oil. So there's significant amount of heat transfer that's taking place. Now that steam that was injected is basically it goes into liquid solution, so it becomes part of the emulsion, and that emulsion, it comprises steam that was injected, so the water, and the oil that was drained, and both of them drained to the production well and being produced to surface, as you can see in that video. So what you have in that pipe, you have bitumen and water. But the other thing that you will have is, for some assets, you will have a methane solution in the oleic phase, which means basically you elaborate the gas that comes out of bitumen, and that also is being produced to surface and processed with those facilities. So, and the other thing here important to mention, that the water is actually being recycled, and more steam is being generated and put basically in the form of steam back to those reservoirs. So that's kind of the core business that Cenovus has, which is, you will see based on the public presentation that I'll be sharing, and those are kind of the products that you can make out of that, so which is great. So before I proceed talking in detail about the company, I also want to show kind of more scientifically what's taking place, just to provide a little bit more insight to how the steam chambers develop and stuff. So what you see here is one second. Yeah, so this is a paper written by my former professor Ian Gates from University of Calgary. It talks about time scales for steam injection and bitumen production and steam-assisted gravity drainage. The one thing I'm really proud of our industry is that we have significant amount of collaboration, academic collaboration, and industry collaboration, and and so what's really cool is that a lot of this paper is being written and all in public domain. So what this one talks about is basically kind of they did some reservoir simulations, and they have some really cool images that describe the process. So what you see here in that picture you can see a cross-sectional view of the steam-assisted gravity drainage process. And this is essentially how the steam chamber is being created. So what you see here is on top of the production well, you see a liquid level. That's kind of where the steam that was condensed in the form of water and oil is draining and being produced to surface. And this way you can kind of control the bottom hole pressure in that reservoir when you inject the steam. So essentially on the sides of this chamber, you have mobilization of bitumen and steam that condenses. So you have that layer of condensation, and you have the chamber development, which is kind of how the process works. And here you can see the kind of the heat transfer element of it, the bitumen drainage, and the bitumen pool at the bottom. So I encourage everyone that want to learn more about the process, go basically and kind of read just Google SAGD, I guess Ian Gates here, and this paper will come up as mentioned. So the way you will simulate it, you'll have like injection and production wells. You have the geology, the representative geology in situ. You can see some of the parameters. So those are very important. For example, the initial pressure in a lot of those reservoirs, you can see it here is 3,000 kPa. 3,000 kPa is like, I used that example in the past, but basically the pressure in the room right now is 100 kPa. In your tire, pressure is 300 kPa. This is 3,000 kPa. But that pressure is there in the reservoir already, right? And in my understanding, this pressure is kind of being maintained. So this is a little bit of a softer process. It's not like fracking. You don't exceed the pressure conditions. And you can see that the temperature specified is 12 degrees Celsius. So basically, what you have there is a kind of almost like a hockey puck that is not mobile. So you will inject steam to liquefy the hockey puck, and then the steam will condense. It will become water, and then you produce the water and the oil to surface. So that's kind of the process they follow. And what I really like about this paper also, they visualize the steam chamber growth over time. So you can see, there was this question, how come, like, for example, companies like Cenovus have such low decline rates? And you can see in this picture, you can see the temperature propagation over time. So you can see how the steam chamber develops over 1 year. So it's just kind of like a small chamber that's growing, and you have like really good production rates. In year 2, the steam chamber continues to grow, and then it kind of grows laterally. And you can also see the picture of the oil saturation that corresponds with those temperatures where you develop those steam chambers. And that's why this process does not have a high decline rate, because it takes years to develop those steam chambers, and you realize very high rates. That's why in the upcoming slides, you will see that Cenovus is kind of very proud of their process and how they produce their product. Okay, so before we move on, let's see what kind of other people are saying about this company from the BNN Bloomberg, making some comments. I know Eric was on BNN Bloomberg late last month, so I think so. Several things he had mentioned, and so I think it's important to cover those. In overall, I would say most of the visitors that come to BNN Bloomberg, they share the kind of the view that we always see from people like on Twitter, what they're talking about. The one of the issues is like this China reopening, right? So it's good for demand. So a lot of analysts that don't know the name in detail will say, well, China reopening, it's really good for demand. The company has a really amazing balance sheet, very little debt. And right now in the space, we will go into details about what those numbers are, just to make sure everybody's aware of those numbers, because that's kind of, I think, the value proposition of those spaces, of those presentations, is that it's a little bit more in depth kind of sharing. You will see comments kind of like that the company is fairly cheap and good name in the sector. Other people, they're saying that the price of oil will decline because of the softening in the economy, and this is not time to buy oil stocks. So some analysts will say that, but again, this is essentially, I don't want to say lazy work, but it's kind of like a call on the oil prices, essentially, right? Where what we're going to do right now, we're going to do a deeper dive. Some people say that the economic slowdown will affect the oil prices, therefore not to buy this company. But then others will say, well, why would you buy this one? You can just buy CNQ, for example. So some analysts will say that, right? So, but in overall, despite even saying like not to buy, they will say the company will still kind of may increase dividends and pay down more debt and comments like that. So essentially, like I don't know how to think about this, about the negative comments here, but I think they're mostly economy related, not necessarily um, company related. Some people said that they prefer, let's say, for example, like Whitecup and Headwater, which is really interesting because um, Whitecup, the Weyburn asset was actually developed by Cenovus, and they invested to Whitecup. So historically speaking, that's kind of what took place. So I think it was kind of like this legacy Cenovus asset for many years. Same with Headwater, for example, the Martin Hills development um, was what happened at Cenovus, and then they did this really interesting deal, kind of 2020 and forward, where they basically sold the Martin Hills Clearwater asset to Headwater, but then they had some shares and then they invested, so ended up winning like big time from that. So I find it extremely interesting, and that I think speaks to the importance of this company, is that you can see kind of the DNA of Cenovus in various other companies, but then some people in our community will get really obsessive about, let's say, it has to be a Whitecup, it has to be a Headwater, but then the origins of those companies are from Cenovus. So that's kind of very interesting. Even though I'm sure they're not affiliated by any means with any of those assets, at least from what I understand from what's been shared in the public domain. But maybe maybe there's some work ongoing, and soon we will see in the slides maybe there's like more development going on in the kind of the conventional place. So I want to speak a little bit more in detail about what Eric said about Eric Nuttall from 9 Point Energy Fund on BNN and Bloomberg at the end of March, and just kind of go over some of those comments. So he had mentioned that that it's he's buying more shares here. So that's kind of what it looks like. I'm not sure if that's what's currently happening, but that at least what was shared late March. And 30 plus years of reserves. We will take a look if that's the case. $70 oil equates to almost 3.5 cash flow per share. So that's kind of what the thesis is here. He expects a price that's closer to kind of $40, and we will see in the presentation as well that they pledged 100% of the free cash flow to be returned to shareholders. We will see kind of in the slides exactly what they're talking about here. And there's a lot of frustration, I think, within the community, is that there was this kind of sell-off, and unclear to why. But I think this company deserves a lot of respect when it comes to its size and what it does. This is not like a small entity, and I think within our conversations, and I'm obviously talking on behalf of myself and not representing anyone, just my thoughts, is like a company that produces 820,000 barrels a day. To expect something like short term is a little bit naive, I think. There was this kind of conversation about the CEO retirement. So Alex Burbet, I think he's going to be like a chair of the company or something like that, and John McKenzie will be the new CEO. There was some concern associated with that. So my understanding, just from my observation, personal observation, is that was about to happen years ago. Like this was very obvious to many people in the sector that this is kind of where it's going. John McKenzie is a very strong executive with a lot of history. He came from Husky, I think, and was really instrumental in transforming the company when it comes especially to the Husky acquisition. So which is, you see, there's a little bit of a synergy there. And so where I think Alex Burbet initially came from TransCanada, TC Energy. And often downtown, like, hanging out in Calgary downtown, you will see those two often next to each other for years now. I think since like 2017, 2018, maybe a little bit later. Yeah. So so I also share this view that this is not a concern. This is not like this is not something that people that are familiar with what's going on are surprised by that at all. And I know some people that not familiar with like the management team are maybe concerned, but this is not the case at all. So very fairly confident that John McKenzie kind of will continue here on the path. That's kind of my personal view of what's been going on. All right, so so what we're gonna do right now, I'm gonna share. Sorry, one second. So I'm gonna share right now. I think I'm gonna start with talking about some of the aspects about the business and really show some slides from their consolidated financial statements for the year. I think this will be a good place to start. By the way, for those of you that are wondering what is he talking about on Twitter Spaces, I'm live on Twitter as well as YouTube, and I'm showing a lot of the slides on what exactly I'm talking about. So here's before I go into details about their kind of financial numbers, and then we're gonna do their presentation. I think it's really important to understand the diversity and the scale of this company. So initially, when I started this video, I showed you the SAGD process. This is essentially kind of oil sands development, in situ development, so bitumen production. And increasingly, you will see how this business plays a significant role in what Cenovus kind of is all about. I think this is kind of the conclusion you will come to. That's at least the conclusion I arrived at, especially based on the numbers. But before we do that, let's kind of go over what type of businesses they have, and then look at the numbers. So on the oil sands side, yeah, so they develop and produce the bitumen that I was talking about. It's as I showed in the map, it's northern Alberta and a little bit of a Saskatchewan there. Their oil sands include Foster Creek, which Foster Creek was, in my understanding, the first commercial SAGD development project in Alberta. That happened over 20 years ago. I think it was like late 90s, early 2000s. And I think what's really interesting to remember here is that it started from zero, right? It used to be Encana back then. So in 2008, Encana essentially, which is Ovintiv today, split to two entities. Back then, it was, as Foster Creek was kind of developing, it was becoming increasingly clear that those two entities, they did not have much in common. And there was this big gas unit, which was all about, Encana was all about that. And then there was this kind of bitumen business unit where it was like Foster Creek and growth and wanting to grow the oil sands production. And at which point the company split to two. So Encana became Encana, and the Cenovus became the kind of independent company where it's like only oil production. Even though it did have a lot of like gassy assets and the Weyburn asset, which is like EOR, and it had a lot of interesting assets kind of all over Alberta, like what today is known as Drumheller, like Torxen assets, conventional assets. It had Prairie Sky, kind of those lands under them, which they later divested as well, which became this Prairie Sky entity, and obviously developed the Clearwater kind of what's known today as Headwater, the Martin Hills asset. That's kind of my understanding of what took place. But Foster Creek definitely is one of those like really important. I think it's about over 200,000 barrels a day right now, and it grew over the past 20 years, to that scale. And I think it's also important to remember like that. I think everything in this sector, it just takes time. Everything takes time. You can see how the recovery kind of the ability to produce the oil, the bitumen to flow, that the thermal angle of it, like kind of like how do you reduce viscosity of the oil to flow and to be produced, the entire concept was developed in like 1920s, 1930s in a lab, right, in the University of Alberta. Then 1978, you have Roger Butler, an engineer for Imperial Oil, developing the SAGD process, 1978. And then about 2001, 2000, you have Foster Creek development, which is the first commercial implementation. So you can see kind of that everything in the sector, it just takes a long time to kind of evolve. But once you do that, everything is in a huge scale and kind of, as you go forward, provides that energy that society demands. So basically we have Foster Creek asset at Cenovus. Christina Lake. Christina Lake is like the optimized version of Foster Creek. It's kind of the sister asset, which is located near Christina Lake. It's kind of more to the south side of Christina Lake, and to its east is Meg Energy as well. And what's even more interesting is that Cenovus, and we will see in the slides, have this asset that's called Narrows Lake on the north side of the lake as well. So that's kind of cool. Now they have additional assets in the oil sands. Another one is Sunrise. So they purchased this asset through the Husky acquisition. Lloydminster Thermal, also known as Lloyd. So engineers will call it Lloyd, but it's called Lloydminster Thermal. And they have some Lloydminster conventional assets. They call it Lloydminster conventional heavy oil assets, which tells me that basically it's non-thermal, so it's kind of like clear water, really. It's like heavy oil, but it's mobile. And Cenovus also jointly owns and operates pipeline gathering systems and terminals through the equity accounted investment in Husky Midstream Limited Partnership. So they have like this also an interesting, kind of pipeline business, operates pipeline gathering system. So like some infrastructure here is taking place. Let's talk about their conventional businesses. They include rich and natural gas liquids, so NGLs. NGL stands for natural gas liquids, and natural gas within Elmworth Wapiti, and soon we will see the map of where it's located. I think that's kind of one of the value proposition from those presentations, that you can really, sometimes we'll have people talking about different assets, but you can't really relate. You can't really see where they're located. So we will show a picture of that. K-Bob Edson, so we'll show a picture of that. Clean water and Rainbow Lake operating areas in Alberta and BC. BC is British Columbia. And they have lots of interest in numerous natural gas processing facilities. So, and I think those kind of came with the Husky acquisition, right? With the Husky deal, where Cenovus NGL's natural gas production is marketed and transported with additional third-party commodity trading volume. So that's really interesting that they mentioned that. They also have an offshore business. The legacy Cenovus did not have an offshore business, but this came with the Husky acquisition. The offshore operations, there's some exploration and development, but as we can see, it does not play a huge role in their portfolio. It's fairly small, and soon we will see the numbers. The offshore activities there are in China. They're in China, right? And they have also east coast of Canada. So they mentioned here they also have investment, so equity accounted investment in Husky Sinuk Madura deal, joint venture in Indonesia. So there is this kind of small, entity that they're invested in. I guess it's from Husky, but is that the core business for Cenovus? I'm not sure about that. Often you will see also how they treat their businesses, and again, to understand this company, you must zoom out. You must really kind of have a view of the bigger picture of what's going on, and then kind of do deep dive-ins into the business units. But I think the numbers that I'm going to show now will play an important picture to really understanding what's important here. So what I described just now, they call it the upstream segment. The upstream segment is really oil production, right? So bring in products from reservoirs. Now they have a downstream segment, which is they allude to the process, they call it manufacturing. So they have Canadian manufacturing and US manufacturing. And this is essentially refining. So they have own and operate Lloydminster Upgrading, an asphalt refining complex. So this converts heavy oil and bitumen into synthetic crude oil, diesel, asphalts, and other products. And it owns and operates Bruderheim crude by rail terminal and 2 ethanol plants. So that's kind of what they have in the Canadian business unit when it comes to downstream. They have a commercial fuels business across Canada, and which is included in the segment. So I'm not sure if this just refers to the Husky gas stations. I assume that's what it is. So if you ever see a gas station and there's like a Husky dog, that could be it. And Cenovus markets its production, third-party commodity trading volumes, in an effort to use integrated network of assets to maximize value. So this is kind of where it comes to the Canadian manufacturing. So in US, so they're also known for their refining capability in the United States. It's fairly massive, so I think it's important to mention. So they refine crude to produce gasoline products, diesel, jet fuel, asphalts, and other products, right? In their wholly owned Lima refinery and Superior refinery assets. So we're going to be seeing, we'll be looking at the map where exactly they're located. And jointly owned Wood River and Borger refineries. When they say jointly owned, they refer the ownership is basically being split, I guess, between Phillips 66. There's also history of JVs with Cenovus and other companies, but yeah, so right now they collaborate with Phillips 66 when it comes to Wood River and Borger refineries. In my upcoming slides, I will show exactly where they're located as well. Okay, and they also jointly own Toledo refinery, and that collaboration is with BP Products North America, so essentially BP. So it also markets some of its own and third-party volumes and refined petroleum products, including gasoline, diesel, and jet fuel. So those, often we will talk about the product side of what the society consumes, and they're basically in the heart of it. So before I go to the slides and show you where they're located, right now, by the way, Twitter Spaces, I'm also streaming live on YouTube and streaming live on Twitter, and I will be showing some numbers right now to better understand this company. Okay, so right now I'll share the actual numbers. So right now we're going to review Q4 for 2022. They're going to be reporting Q1, and this is kind of going to set the setting for what's going to come up here in Q1 and better understand what's been happening. So what you see here, basically, it's all in millions. So when you see 6,731 as highlighted right here, that's in billions. So that's $6.7 billion in gross sales in basically 3 months. Yeah, so that's why sometimes, when within the community, I get a little bit frustrated because, some people think, especially the traders on Twitter, they're like, well, why is this company continuing declining? Why is it not doing better? Or there's this frustration, but there is no respect to the scale of this company. There is no respect to the scale. And it's a massive company. And I think it's important to see exactly in those numbers who they are, what they do, and maybe have somewhat of a more realistic expectations to how this company should perform over time and at which times it does well. Okay, so let's go over the numbers. So I describe basically 2 core businesses. They have the downstream manufacturing, that's what it's called in Canada and US. I think between the 2 of those manufacturing assets, which is essentially refining, like that's a simplified word for all of it. They manufacture about, I think, 740,000 barrels of oil with the products, right? So that's massive scale. And I think in addition to that, they produce about 820,000 barrels a day in their upstream business. And that's what you see in this slide here from their results. So let's take a look at and kind of have some kind of analytic view of why we will kind of arrive at the conclusion what will be the core businesses for this company and what will not. And I think one thing that I encourage you to do if you want to be a little bit more of a deeper dive in those assets. As I mentioned, for example, the gross sales or basically the segment income, one could kind of derive the free cash flow from that. Take a look at those numbers from a perspective of the time frame. So how long this quarter was, which is always about 90 days, right? So 3 months, and then divide that number by the production as well. This way, you arrive at the price that was received for the product. This way, you can also see the expenses. So when we have Twitter gurus doing economics on things and make assumptions based on oil price, at least from here, you can say, okay, 2021, this was the volumes, this how much cash was generated. 2022, you can have your own, in a very simple calculation here, by dividing by the number of days and the volumes of oil produced, which we will share shortly here. You can see the netbacks, you can see what's being spent and the margins associated with each and every business. So let's go and look into detail. So gross sales for 2021 and 2022 were very close. So you can see $6.7 billion. Then you can see right away they pay royalties on those sales, right? And we're looking now at the oil sands assets. So those that I described, Christina Lake, Foster Creek, Lloyd, all of them. You can see the products the expenses associated with their operations. So you can see transportation and blending by far the biggest expense. The reason why they have to spend that money is that, as mentioned, the oil that's being produced is just too viscous. And when they transport this product, let's say, to the different refineries that I described, they need to dilute that oil with a lighter product. So something like a hexane or a pentane. And so they need to transport and blend the product, right? So that's kind of what they're alluding to. And there is an associated cost associated with that. Also, they have some language here on realized gain loss on risk management. I assume that alludes to hedging. That's kind of my understanding. Maybe I'm wrong on that. And then purchase products, so on the oil sands here. So just things for their operational kind of, for the operations. So then we get an operational margin here. Operating margin, depreciation, depletion, and amortization. We need to do a deeper look into those numbers here to better understand what's going on. But then you can see on the segment, there's $860 million that was made in one quarter, basically on the segment income for the oil sands. Now, if you look at the other upstream segments, you can do a very similar kind of analysis, and you can see how the conventional is just much less. It looks like it's like, I don't know, so 1/7, so it's $1 billion in gross sales, and then you basically have on the margins, you get paid on the income, 154 million versus 860 in the oil sands. So then the question is, what is the core business, right? If you look at the upstream offshore, it's even smaller than the conventional business, and on the income side, you get 197. So they had much better year in 2021, so 294, and with conventional they had 575. But in overall, you kind of on the segment income, you can kind of see out of the 1.2 billion dollars of segment of the overall income for the segments, 860 million out of that is from the Canadian oil sands. So this is really in its core, I think it's an oil sand company, right, with all those additional assets. Okay, so right now we're going to be looking at the Canadian kind of manufacturing segment for Q4. And before I proceed, I think what's going to happen, I think in Q1, is because, and I shared this before, I think WCS has a very kind of similar overall average value in relation to Q4. We've seen very similar kind of prices, but it's almost like a mirror image of what was happening. If you Google WCS price, you will see basically a decline. I think it was from, I don't know, $70 to like maybe 50, maybe 40, something like 40 in the WCS. And then you saw this like December bottom and you saw a quick recovery. So if you do an average, Q4 was like a lot of like Q1 when it comes to prices, but maybe like a mirror image of it. It's kind of like for the wrong reasons, it was very similar. And right now, I think WCS is $67, which is wonderful price for a company like Cenovus. So what you also see here is their downstream segment. And again, you can see Canadian manufacturing, so they're Canadian refineries that we talked about. Gross sales $1.7 billion, but the segment income, like on what they actually get, right, is $234 million. But you can also see how much they basically spend on expenses, and with all that, operational basically activities, you're left with very little. And I think that's kind of the one pushback that you have against kind of like the refinery businesses, because the margins are just like so small, because you spend a lot of money, but you get paid a lot, but you also spend a lot. That's kind of what it comes down to. And you can see here, basically, U.S. manufacturing, again, you spend a lot, you get paid a lot. I think this is like $6.6 billion here. But on the expenses, you have 5.7, you have 0.5, right? By the time you're done, you basically almost like breaking even, or just a little loss here on the U.S. manufacturing for Q4. Yeah. So now let's take a look at, again, if you're confused by what I'm showing here, I'm on Twitter Live as well as on YouTube Live, showing slides. My ticker is Razor Oil, and I'm just going over Cenovus, trying to explain their business to advance education, I guess, on Twitter, and help people to better understand those companies and what they're all about. This is my personal view. There's no conflict of interest. I don't have a current position, but I did work up until 3 years ago. I spent close to 10 years of my life working for Cenovus. It's an amazing company, but I don't have professional affiliation right now with them. So, and I'm just doing this for educational purposes, trying to share. I cover other companies as well. It's all free. I don't sell any Substack or don't have any products. This is just me kind of trying to advance more education and kind of understanding of those businesses and why I think they're important. Now look at this. We're looking right now at the annual basically operations for Cenovus. Look at those numbers. For upstream oil sands, $34.7 billion gross sales. Unbelievable. So this is a company, I think their market cap right now is like 51 billion, and I think they have something like 4 billion in debt. They're able to, the cash flows, right, with the sales, the cash that's being kind of going in and out of those businesses is significant. It's huge, right? So that's why, like, just think about those numbers. That's why, like, and I shared this before, I don't want to repeat it too much. We see a lot of impatience on Twitter, like some traders especially, like, oh, why is it not doing better? Why is it not doing, why am I not getting paid like 10% daily? Why am I not doubling my money every couple of weeks? Well, those businesses, they're just not doing that. This is not like small companies, right? On the oil sand side, they're also, like, if you look at the expenses, so they have 4.8 for purchased products. Transportation and blending, again, plays an important part in our operations. I alluded to the fact that they need to basically dilute the product with lighter oils and transport them to the refineries that I shared. And in overall, you can see kind of the operating margins here, and the segment income is $6.2 billion, right? So you can kind of derive the free cash flow from that. This is significant, right? So if you basically a 55, let's say, billion-dollar company, you basically have this type of segment incomes. You can start like allocating cash. You can buy back shares. You can reduce debt. You can do lots of things here. On the conventional upstream business, that segment annually generated $0.8 billion. So again, what's the core business here, right? 2021, the segment income for Cenovus was 3.6 billion. In 2022, $6.2 billion. For conventional upstream, it was 0.8 billion for 2021 and 2022, which is relatively small. For their offshore operations, it was close to $1 billion for the segment income in 2021 and 2022. So in overall, you can see that 6 out of 8, basically, the 6.2 billion out of the $8 billion in segment income for this company came from the Canadian oil sands, and it speaks to the significant kind of netbacks that the company can generate. And again, by using a very simple calculation, you can take 12 months, so 365 days, right? You basically take their production, divide by that number, and you can come up with the netback number. Let's take a look at the downstream for the 12 months here. So you have sales at 7 billion for Canadian business unit, $30 billion for US manufacturing. This company is a big player when it comes to US refining. It's a big player. But look at the segment income, it's about $1 billion. So they basically generate 30, they spend about 29 and make a make $1 billion, right? So big difference between the margins you get from the upstream Canadian oil sands business and what you get on the downstream for US manufacturing, which is essentially the refining business. In total, it's about $1.5 billion in that segment, where it's like you can generate like 6.2 in their upstream oil sands production. So I think it kind of speaks, maybe one could arrive at the conclusion that owning so many assets, so many key assets, but at the same time you have this one jewel in the form of the Canadian kind of oil sands that generates majority of their free cash flow, I guess. And where is this company going from here? So I think it's something that I want to leave with the audience and make each and every one of you arrive at your own conclusion, kind of what you think about that. Okay, so right now I'll share the corporate slides, what they're basically talking about, and maybe spend another 20 minutes in this space, and then we'll just kind of continue with our day and just kind of go from there. Okay, so what I'm sharing right now is their corporate presentation. When you open their corporate presentation, for most people, this picture, it's a really nice picture, and it's kind of like, oh, that's a nice picture. But I want to talk about this picture a little bit more, because I think this picture explains a lot about their upstream Canadian oil sands business. So what you see here, I'm not sure whether it's Foster Creek or Christina Lake, but here at the center, those facilities, those are CPF, central process facilities. And what you see in the kind of the I guess the southeast corner of this picture, you can see a SAGD pad. So this is a steam-assisted gravity drainage pad, and you can see what leads to that pad from the central process facilities are what looks like two pipes, right? They kind of go in the middle section, kind of leading towards the pad. If you zoom in closer, I think there are actually three pipes. One is leading from process facilities towards the pad that carries the steam that will be injected on that pad. And the other two pipes basically carrying the emulsion back to the central process facilities and the gas that comes out of the reservoir. And it's being processed at the central process facility. So this picture, I really like it, because once they operate this pad, and it will take maybe, I don't know, 10, 15 years, this land, so all those facilities are being removed, in my understanding, and it's being reclaimed. So you put the forest back where it was, and that's it. So there's no tailing ponds, there's no like any environmental kind of, uncertainty here. It's basically you take the facilities, put them somewhere else, and put the forest back to where it belonged there for millions of years, which is really nice. That's why I'm really proud of that sector, that they're able to kind of reclaim the lands and do it in a very kind of responsible way. That's my personal view. But you can see how this business is extremely efficient that way, because once you did that pad, you still have the central process facilities to generate more steam. So you can drill another pad and allocate that steam there and produce the oil from there. So, and that's exactly what's going on in this sector. That's why it's just such an exciting business. Okay, so let's see why Cenovus deserves every respect on earth for what they do in the scale of their operations. And again, the product that they supply is the product that society demands, right? This is just what we need now. We have President Biden openly says that the companies shouldn't be buying their shares back. They should be producing oil. And I think Cenovus is kind of doing both. And, that's at least what we're going to be seeing here. But at the same time, this company is extremely massive. Now, based on these numbers, I will let you decide whether you think this is a fair value for this company. So think about this. Market cap $51 billion. This company produces 820,000 barrels a day. From those three segments that I explained, oil sands segment, they produce 612,000 barrels a day. So that's mainly from Foster Creek, Christina Lake, and the Lloyd assets that were described. Conventional asset is 133,000 barrels a day, and offshore is 72. I think from the statements we saw that offshore, actually the netbacks were kind of a little bit better, I think, for the segment income, where conventional it was way less than the oil sands, but oil sands, I think it was something like $6 billion in 2022, which is great. Look at this number here, upgrading and refining capacity. So between the two downstream segments that I described, 740,000 barrels a day, 740,000 barrels a day are being upgraded and refined for Cenovus Energy. So this is like a fully integrated company. It has upstream business, it has downstream business. It's amazing. Now think about the consumption in the United States for the products. It's about 20 million barrels a day. This company produces 740,000 barrels a day. So it's a big portion of what United States and Canadian refining capabilities are and what's required. For 2022, the proved and probable reserves, so those are 1P and 2P reserves. So if you ever see 1P proved and 2P proved probable, right? So basically it's a little bit less uncertainty on the kind of probable 2P, 8.9 billion BOEs in situ. So which translates to 31 years of reserve life index, 31 years. So think about this. Let's say I'm not recommending buying this company. I do it for educational purposes, and hopefully it adds a lot of value to you guys. But if you, if for that segment, if you created $8 billion, right, for the overall netbacks for the segment income that we covered, and the company's enterprise value is, let's say, $55 billion, right? So basically, in let's say 8 years, you're at 64 billion, right? Or let's say $60 billion, or 7 years, you're like in the 50s. So, and then you have essentially 20 years of free reserves live index, basically to produce the oil. So when it comes to longer term investment, and I think that's what Eric Nadal is alluding to when he's talking on BNN Bloomberg, you basically have a situation here where if the oil prices continue to be elevated, you generate that income, or free cash flow, you do something with it, but then after 7-8 years it kind of pays for itself, and then you have like 22 years of basically free production that it's basically like kind of free money, if you will, right? So I don't really want to speak to if that's kind of what he describes. That's my interpretation of what this means. But yeah, 30 years of reserves. They don't really have to go and buy anything here unless they really want to. But we have a very, very interesting dynamic here. So let's see a map. So right now what you see is a map of where those sites are located that I described for each and every segment. So what they say here, we have high quality, diverse and integrated portfolio, geographic diversification, physical integration, and market access. So what you see here, basically how the core, I will not even be shy about this. The oil sands business is their core business. That's what the circle shows here. Look at this, 612,000 barrels per day, BBLs per day, conventional 133, offshore 72. Look at that operation, right? And this is basically located here. China, they show only one here in the picture at the bottom. Indonesia, Madura, Asia Pacific. And then basically when it comes to the oil sands, they talk about Foster Creek, right there, Christina Lake, Lloyd Thermal. So those are the key assets. And then when it comes to upgrading, refining and upgrading, the network of the refineries that you can see here on the map. So essentially, they have this Superior refinery here, right? Toledo refinery, Lima refinery that we described, Wood River refinery, and Borger refinery. I think that's what it's called. So, so really interesting kind of integration in North America. In addition, you can see with the conventional assets they operate, which, by the way, I got, if anybody from Cenovus here watching, your legend here is a little bit tricky because you have a dark triangle here for conventional, but that's supposed to be a dark circle, and thermal oil is supposed to be a dark circle, I guess, and not a triangle. So if somebody here watching from Cenovus, just fix that, please. But anyway, you have the conventional assets, Rainbow, the Basin. You can see where the Hardisty terminal is located, where the Bruderheim oil crude by rail is located. So very integrated kind of in Alberta. And then you can see almost the vein stores, the refining. And that's when we say a company is fully integrated. That's what we call in full integration. 740,000 barrels a day on the downstream side, 820,000 per day on the upstream side. Look at the volumes here. Toledo 160, Superior 49, Lloyd 110, Wood River 248,000 barrels a day refining capacity, Lima 175. Okay, so we're getting very close here to the hour, so maybe I'll spend another 10 minutes and kind of speak about key slides that I think it's important to understand about Cenovus. So fourth quarter production, 807,000 barrels a day. Cash from operating activities, almost $3 billion. Adjusted funds flow, $2.3 billion. Free funds flow, $1 billion. Excess free funds flow, $786 million. Net debt, 4.2. So we saw the market cap, $51 million, 4.2 in net debt, which is really cool. Okay, let's see here. So what this slide is showing is their disciplined capital allocation priorities. So what they're basically saying, they have different categories here. So if net debt is over 9 billion, 100% of the net debt of the cash flow goes to net debt reduction. So that's what they told us. If you between 4 to 9, up to 50% net debt reduction, and then the target 50% shareholder returns. The defined shareholder returns, opportunistic share buybacks, and variable dividends. That's what they're telling us here. Now, if you're below 4 billion debt, and I think what they said here is that they're 4.28. So they're $282 million away from reaching the target. They're basically saying that the target 100% shareholder returns, opportunistic share buybacks, and variable dividends. So we're almost there. So this is a very interesting scenario here that I think Eric is right. He said it on BNN Bloomberg. We're going to the slides. We're trying to understand their balance sheet. That's exactly where they're at. They're getting to that $4 billion with the target 100% shareholder return. Now, could they make any deals here? Perhaps, I don't know. They're massive, right? They're big enough. Maybe they could get opportunistic here. But they do say that they will return this 100% of the shareholder, 100% of the cash flow to shareholder returns. Okay, so let's see here what it means, debt reduction in 2022. Look at the net debt, right? So it's roughly $4 billion here, almost there. Long-term debt is just over 8. But apparently they have some cash on the books, which is very interesting. So they have over $4 billion in cash as well. I don't know why, but if this is something to keep an eye on. Okay, so let's look at the 2022 shareholder returns, over $3.4 billion return. They're suggesting it's 7.7% yield. And they basically describe how they gave you $219 million in variable dividend. In 2022, they spent $2.5 billion on share repurchases, which is interesting. And they had the base dividend, which is $682 million. Okay, so this is a really cool slide that I really like. It speaks to kind of their ability, for anybody interested. I'm doing a live on Twitter Live and YouTube Live for the slides, but also do it on Twitter Spaces. 2023 capital investment in illustrative adjusted fund flow. But for me personally, it really speaks to their break-even ability. Like, where do you break even? So you can see here capital investment roughly $4 billion. at 45 WTI right here, right? For those adjusted funds flow, you are at that number. For 60 WTI, so for $60 US WTI, you're getting to that $7 billion here on the adjusted funds flow. For $80, you get to 12. And that's the opportunity that's really associated with this company, is their really low cost of supply. So the 2023 budget expected to generate free funds flow across the price cycle. And you can see how the investment included in 2023 budget expected to deliver cost of capital returns at $45 WTI. So that's what the company is saying. Like, I'm reading this right now and I'm like, I can't even believe what I'm reading. Just think about this. And I'm not trying to promote this company. I don't hold shares right now. I'm not affiliated with them by any means. This is for educational purposes. But what they're telling us right now is that investments included in 2023 budget expected to deliver cost of capital returns at 45 US WTI. 45. Right now we're like over 80. Okay, so let's see their optimization and growth strategies. So we have basically the allocation of capital for the growth strategy. I think we did a good job trying to cover basically the various segments and where they operate. I think it's really important. And now we're trying to really zoom in to what's the growth opportunity here, what's the optimization, and the capital involved. So what they're telling us on offshore, they want to spend $600 million. I think for that segment for 2022, they made close to $1 billion. So yeah, it makes sense they will spend $600 million, because for the next 10 years, they can make 10 times that, right? Downstream, $300 million, conventional 75, and obviously big portion, $500 million on oil sands optimization, which is roughly $1.2 to $1.7 billion. You can see for oil sands, they want to grow some production here for Sunrise by 15 to 20,000 barrels a day. Narrows Lake tie back 20 to 30,000 barrels a day. That's what I was talking about when we talk about Christina Lake. They basically go around the lake and tying in that asset that sits in the north corner. And Foster Creek debottlenecking is over 30,000 barrels a day. For the Atlantic assets, West White Rose Project 45,000 barrels a day, Lloyd Refinery 3, and Lloyd Feedstock Replacement 15,000 barrels a day. Okay, I'll try to skip a couple of things here and just kind of go to the things that I think are valuable. So again, you can see in the oil sands, they say best in class with low cost structure and long life reserves. Christina Lake here. Christina Lake is basically next to Meg Energy. So Christina Lake, it's like an actual lake. Meg sits to the east of the lake, and Cenovus sits kind of to the south of the lake. You can see they produce between 235 to 255 thousand barrels per day for 2023 goals. Look at the operating expenditures here, $8.5 to $10 per barrel, right? So often people will ask, well, how much the Canadian oil sands OPEX is, like what's the operational cost? Well, they're telling you $8.5 to $10, which is very little. Industry leading CSOR 1.9, amazing. Guess what? We did a live a week ago on Meg Energy. They told us we're second best at 2.2, I think, SOR. Well, we just found the best. Industry-leading CSOR of 1.9. CSOR stands for cumulative steam-to-oil ratio. So what that means essentially, for every barrel of oil produced, they inject 1.9 barrels of steam. And they have cogeneration capacity of that they describe here as well. That's kind of in additional, because when they burn that natural gas, they generate steam. So they have like a cogen capacity. So I think it's kind of speaks to, their efficiencies, but I don't really have the numbers to tell you like how much money they're saving or making. I think Meg did a good job showing us what that is. I think they have also cogeneration capacity there, but I'm not familiar exactly with what they can do here. Foster Creek, as mentioned, the first commercial pad on SAGD in the province of Alberta, 180 to 200,000 barrels per day in 2023, slightly higher OPEX, right? It's a little bit of an aging asset. So 11.2 to 13 per barrel OPEX, CSOR 2.5, which is really good. Lloyd Thermal, a much smaller asset, 105 to 115,000 barrels per day production. And you can see Sunrise up to 50,000. Again, slightly higher OPEX, so $18 to $20. And Lloyd conventional heavy oil, 17 to 22. So now we start comparing, hey, you can produce heavy oil conventional, but basically so you can produce 17 to 22,000 barrels per day, but your OPEX is $40 to $43, where you can do Christina Lake and it's $8.50 to $10. So that kind of speaks to how powerful those thermal assets are. Let's speak a little bit here about the optimization and growth opportunity. And I really like this map, so I want to share this with the community. So then there's really good understanding of the conventional assets and where they're located. So let's take a look. So often you will hear a lot of my friends here talking about Wapiti and Kakwa and Carr, right? Like all those assets kind of like closer to or within the Montney, right? So you can see it clearly on that map. So you have this northern corridor right here, Elmore, Elm, Worth, Wapiti, Kakwa, right? Carr, all next to Grand Prairie. So kind of going into kind of BC, Montney region, right? So those will be kind of like gas, liquid rich, NGLs, natural gas liquids kind of assets that they have. Then if you go a little bit kind of towards that southeast corner, you get the K-Bob, the Two Creek, Edson, you can see it here on the map, and Clearwater, kind of all the way down to Sylvan Lake and Red Deer. So you can clearly see on the map where those assets are located. And then in yellow, you can see also Cenovus's lands, where, there's some random lands there up north, Sylvan Lake, undeveloped, but you can see Clearwater, Edson, Northern Corridor. Are those assets are core assets to the company based on what I just saw? And again, I have no idea whether they are, but they're talking about focused development activity in 3 key operating areas, Northern Corridor, Edson, and Clearwater. But the numbers suggest the key assets are really in the oil sands. So let's see what's going to happen with this. I mean, they're massive. Their operations are absolutely massive. So I think they have a lot of kind of assets here where it will be very interesting what John McKenzie thinks is core assets and whether they're going to be opportunistic in growing some of those, or maybe they will be able to sell some of those assets and maybe grow their oil sands production and maybe enhance their downstream business. Because we saw in economics, it kind of, the upstream businesses are kind of a little bit more torquey to higher oil price. But, if you have crack spreads that are elevated, maybe the downstream businesses will outperform. So that could be interesting. Another thing here, that's kind of the offshore business, right? So the Atlantic and the Asia Pacific businesses, I don't know them that well. You don't see much of the language here. Here they talk about, they have some language here like de-risking portfolio with changes, working interest, exposure to Brent plus pricing. But they do mention high netback production with exposure to global oil prices. But again, they don't really talk much kind of, when it comes to basically their operations, I don't know if those are like their core assets. They could be, but I don't know. Let's see exactly what they say here. West White Rose project, the first oil expected in 2026 with production at 45,000 barrels per day. Yeah, interesting. But they show you some basically the profile for first oil, the production profile. So it's basically under development right now, and currently seems like 10,000 barrels per day, and then somewhat flat and with opportunity to be at 5 times the production. But I don't know. It meets investment criteria at $45 US WTI, but let's see what's going to happen there. They say working interest 56.4% in White Rose growth, optimization growth capital $600 million in 2023. So they are spending some money, but let's see what's going to happen with that. And then obviously they talk a lot of detail about Canadian manufacturing, US manufacturing, everything we mentioned so far. They have the Lloydminster upgrader, produces high quality, low sulfur synthetic crude oil, diesel fuel, recovers diluent from the feedstock, condensate is cycled back to nearby thermal operations. So those are the products you will need to transport the bitumen. They have the Saskville refinery and Lloydminster refinery, commercial fuel business, They have the Lima, Ohio, the Toledo, Ohio, the Superior, Wisconsin, the Borger, Texas, 50% interest refinery, and Wood River. So 173,000 for Wood River, 75,000 for the Texas refinery at 50% interest. Superior, Wisconsin, 50,000 barrels per day. So you start seeing like this company is not like it's massive, right? There's a lot of segments, a lot of operations, a lot of assumptions that need to be made here to understand it. And that's why I think the education segment here, especially for the Twitter community, is to say, look, if you are investing in Cenovus, you have to take a longer term view on basically utilization of oil in society, because this is a fully integrated, massive producer and massive refiner of products. So just something to consider. Okay, maybe we can look at kind of final slides here and conclude the space, because I think my friend Shabam is going to have a live for his program there, what he wanted to share. So I don't want it to overlap with what he is up to. But you can see for a 2023 budget overview, they want to spend $4 to $4.5 billion here. There is an increase of 21%. One could argue maybe it's associated with inflation, but maybe they just want to grow some production here and kind of, have a little bit of a, more optimization, right? So upstream production, you go by 3%, but 3% for a company like this is massive, right? So you go from 800,000 barrels per day to 840,000 per day range. And I think today is 820. So maybe they bring in additional like 30,000 barrels per day in 2023. So upstream production of 800 to 840, downstream 610, 660,000 barrels per day. That's for 2022. Oil sands operating cost about 12.5 to 14 barrels, and we saw how basically this number could propagate from, like, let's say $9 for Christina Lake and a little bit more for Lloyd, and U.S. manufacturing operating cost 11.25 to 13.5 per barrel, which is a 22% decrease versus 2022. So let's see now what they're yielding, basically what they're saying for production through output for production through or throughput for 2023 guidance, right? So for oil sands, very similar range to where for 2022 was 800,000 barrels to 840,000 barrels per day for total upstream, and for total downstream, basically they indicate that as well here. At 610 to 660,000 BOEs per day. That's kind of what it shows. I need to do a little bit of a deeper dive to see why the total downstream number is, I think, a little bit less than last year. So maybe we have some refineries that are going to be doing some maintenance, so I need to investigate this a little bit more. Why the total downstream number is a little bit lower than I think last year. No, they actually say downstream throughput 610 to 660. Oh yeah, so maybe they refine on the product side 740, and the input is 610 to 660. That's right. So maybe there's like a conversion going on between the oil products that coming into the refinery and what they actually produce. So that makes sense. So everything looks just like last year for 2022. Yeah, looks good. Okay, so they have way more slides here basically on the different commodity prices assumptions. You can see in the slides as well, Brent here, right? 2023 scenarios for $45, $60, and $80. Some express frustration to why you don't have, let's say, $100 scenario, right? So, but will be interesting to see kind of what prices we actually get here. And let's look at the final kind of map here before we conclude. And I think this company is just something like you can talk about this company for so long, right? Like it's just so huge. But let's see here on the map what they're talking about, kind of where the assets are located. So you can see Foster Creek region. That's kind of the Coal Lake bitumen production. Christina Lake, just as mentioned, this Athabasca region. Narrows Lake. There's a lake here between the kind of Narrows and Christina Lake assets. West Kirby right there. Steep Bank, Telephone Lake, Wabasca there, Sunrise right there. Yeah, so thanks for sharing this map. I think it will help people. And then Loy Thermals there, like a little bit kind of spread. You have this Edom West, Edom East, Rush Lake. I'm not very familiar with those thermal assets because they came from Husky, but nevertheless, like that's where they are on the map. So that's kind of cool to see. Okay, well, and there's an advisory here that provided and some definitions from Cenovus. So anyway, I think I'll stop it here. So just wanted to thank everyone for joining this live. This is available on YouTube Live and Twitter Live. It's recorded. Also on Twitter Spaces. Thank you all so much for joining. I tried to cover Cenovus Energy. I think so this space was really for educational purposes. My understanding of Cenovus is that with the 30-year life index, low operational constraint, like low operational cost, significant oil production opportunity to grow here, their downstream business. This is a very interesting company that one should consider. Often, you'll see, let's say, $120 per barrel price. I think last year, 2022 February, dropping all the way down to as low as like 60s and now back to 80. One could say, well, companies are not doing well because oil prices dropped. Well, this company clearly tells us they're doing quite well. So this is something to consider. Please consider the fact I'm not a financial advisor. This space was not a financial advice or promotion. I'm not getting paid by anyone. You could support me if you want by looking up my book, Apollo Autism. It's part of my advocacy on Amazon. It's called Apollo Autism. It's a really cool story, and I think the net value there is that it's really trying to create a happier future for people that reading this book, and kind of a really cool story about an engineer that used to work at NASA during the Apollo program and his journey. And overall, thank you so much, everyone, for joining the space. This was not financial advice, for educational purposes only. Hope you enjoyed this and added some value to you. You better understand what Cenovus is all about. One thing I have to conclude that, this company deserves a lot of respect from the investment community. It's massive and it's an important entity in the Canadian E&P space. So thank you all for joining, and I will see you guys next time. Thank you.